Let me now bring on board Pankaj Pandey, he's Head of Research with ICICI Direct. Pankaj, good morning. Thank you for joining us. Pankaj, 2 weeks ago, we were staring at a picture-perfect scenario, but suddenly things are looking tired. Benchmark indices are not going anywhere. Mid-cap stocks have caved in. The demand-supply equation has changed, and in the near term, there are no fundamental triggers which suggest that markets want to go higher.
You're right, Nikunj. I think there is some sort of fatigueness which is there in the market, and even from a fundamental perspective, if you look at last 2 years, we had single-digit EPS growth. Now, probably for next year, we are expecting a Sensex EPS growth of about 17%, but a lot of it is already there in the prices. And also, I think there's a big overhang in terms of what the government will do in terms of budget, which is the next crucial trigger. I think the government has been taking a number of positive steps, but there's an inherent fear that probably all these measures in terms of policy reforms front probably might be sort of creating a headroom for some kind of a populist measure which might come in the budget or somewhere down the line in the next 3-4 months. I think till the time you have these kinds of concerns, probably markets may not really head up higher. So we get a sense that from here on, the upsides at best could be in single digits. So which is why I think it is better to book some profits, and probably I think that is also sort of reflected in the market breadth. If you look at for the past few sessions, I think it's been quite weak. So in that sense, I think time to book a certain amount of profits. And I think once you have clarity as to how things pan out from here on from the government front, I think then only one could take a fresh call.
Pankaj, hi, morning. NTPC kickstarts today. Can we see any replication of what we saw from Oil India in terms of a success story?
I think from the pricing perspective, if you look at there's limited downside from current levels. The stock hasn't done much over the past few years. But from an operational perspective, if you look at the 9-month, even the last quarter results have been quite good operationally. I think in terms of capacity expansion, if you look at for the 12th plan, I think the company is going to add about 51% of the capacity over the next 2 years. That is by FY14. So they'll be achieving 50% of the entire target for the 12th plan. Valuation-wise, it is quite cheap at 1.5 times book. So that way, the entry levels are good, but the upside remains a question mark. It might be a long wait before we get some meaningful upsides in the stock because of the overall macro concerns. So from a 2 or 3 year perspective, it does make sense to subscribe to the OFS. But I think one needs to be sort of patient enough in terms of capturing the upside.
Pankaj, the downside is limited, but the upside also is capped for NTPC. I mean, what differentiated NMDC OFS was attractive valuations. What differentiated Oil India OFS was hope that subsidy burden will be fixed. In terms of a policy, trigger, NTPC has nothing.
If you look at, like I said, the capacity expansion is, I think by FY14 we are expecting a capacity would be over 40,000 megawatt plus. I think a return ratio wise, we are expecting 100 bips improvement. And also there is a good chance that the government might look at the regulatory ROEs, which might sort of improve going forward once it gets reset in FY14 onwards. So basis the formula which the government has. So I think all that might be slightly positive for the sector. Compared to some of the other players, probably I think this is the only player which has got least risk in terms of the kind of balance sheet it has, and plus I think on the expansion side, if you look at the expansion in this year also has been pretty smooth. So I think that is from a scarcity premium, if you look at, I think this particular stock clearly stands out among all the peers.
What is the deal with Maruti? Do you think it's only the weakness in yen which is driving Maruti? Because if I look at numbers were okay. Car sales are slowing down. The passenger car market is only getting more intensified. And if I pick up the Economic Times, all I can see is cars are now available at discounts.
Well, you're right, Nikunj, that yen weakness has got a lot of role to play in terms of the kind of price appreciation what we have seen in Maruti. But I think from a number perspective also we see improvement happening, because I think last year was a bit of a abnormal year for the company, wherein you had strike and that impacted volumes. So in that sense, from a EPS perspective, we are expecting about 100 kind of a EPS in FY14, and in FY15 we expect even better set of numbers, so about 132. So in that sense, the stock is available relatively quite attractive compared to a lot of other two-wheeler players. So in that sense, one can still look at this particular counter. And also, if you look at last quarter results, there has been improvement in EBITDA margins, and probably going forward, once if the government does the correction in terms of the kind of diesel vehicles, I think you will see this company has got a good petrol portfolio. So in that sense, this company would be a beneficiary of that, and which is why we are positive on the stock, and we have a target price of 1780 on the stock.
Are you a bit worried about the kind of data points we are getting from consumer companies? First it was HUL, then it was Colgate, then Jubilant, and now last night it was Specialty Foods.
Well, you're right. I think more than that, if you look at most of these stocks were quite actually priced to perfection. So in that sense, you had Jubilant, which was trading more than 50 times FY13 basis. HUL on a forward basis was somewhere about 33 times. So when you're trading at such expensive valuation, then there is margin of error is, I think, even if a slight disappointment will cause huge volatility in the stock, which is what we are seeing. But my sense is that any kind of a weakness in these stocks should be sort of bought into from a 2 or 3 year perspective, because what I would expect is that the world has really not solved their problems. So it is quite possible that you could see some of the macro problems heading back to us down the line. So which is why I think again you will see a race towards defensives happening. So any kind of a weakness should be bought into. Though from a price appreciation perspective, these stocks may not really sort of outperform the markets, but I think from a 2 or 3 year horizon perspective, I think it does make sense to have some of these stocks in the portfolio.
Your take on what we're seeing from the pharma space in terms of earnings growth? It was Sun Pharma earlier, and Cipla is something that the market would react to today.
Well, yes, I think Cipla's number was slightly below expectation, though we don't have a coverage on the stock. But I think there are certain stocks which have done quite well. Lupin numbers were quite great. I think the kind of growth which they have showed in the US and the Europe and the Japanese market is quite good. And I think Sun's tariff numbers were also quite impressive. If you look at the company had guided about 30% kind of a growth, and they have already achieved 50% kind of that growth in the first half, and likely that the numbers are going to be extremely good. So in that sense, I think within defensives, if you look at pharma is relatively reasonably priced. So most expensive stock in the pharma space is Sun Pharma, which is 24 times forward basis. So in that sense, compared to FMCG, this particular space is delivering on the earnings front, and plus is reasonably priced. So which is why we believe that this stock, this particular sector can do better within the defensives compared to FMCG. So I think some of the tier 1 names is people can look at, because all Sun Pharma and even Lupin has been sort of delivering consistent set of numbers. Besides that, we are also positive on Cadila Healthcare because we expect earnings to grow at about 23%. So I think these are some of the stocks we would be looking at.
Pankaj Pandey, what are your thoughts on JP Associates?
Earlier, fundamental, we had a target price of 94 on the stock. I think we had seen a good run up in the stock because of the monetization of cement business, like you said. But I think now the hopes of that happening are fading off. And in addition to that, I think probably the company would be raising money through equity. So from asset sale, it has got converted into equity sale. I think which is what the market probably is not liking, and I think the market had waited for quite some time for this to happen. So if since this is really not happening and does not look like it is going to happen anytime soon, so which is why I think probably we are seeing some kind of a profit taking or some kind of reversal in the kind of appreciation what we have seen. So in that sense, I think post results we'll have a look at the numbers, but I think the stock could have sort of been related because it is the only stock which is trading above one-time book. So if the company had gone ahead and done the monetization, I think you could have seen further re-rating. But again, I think it is quite possible that it will also trade below book values going forward.
Once NTPC OFS sails through, do you expect market activity to pick up then?
I think more than that, budget would be a crucial trigger, and in case if the budget is kind of a non-event, I think the focus will again shift to what kind of populist measure the government takes. I think that is the crucial commentary we would really like to watch. I think probably going forward, it is quite possible that once you have the budget or some populist measure might happen 2 or 3 months down the line. So that is the biggest worry. Otherwise, I think from the support perspective, inflows are still robust. So that is the only positive which is there in the market.
What do you mind could be the big story for 2013?
I think one of the key sectors which we would be looking at is one is telecom and the PSU banking space. So in telecom, I think the regulatory uncertainties about when, so you'll have a fair clarity from the regulatory perspective. I think another factor would be that now we are clear that you will not see too many number of players really chasing the entire opportunity. So in that sense, I think the telecom is one sector which which has defensive properties, and probably I think that is one thing which markets could probably look at going forward. So I think this is one big sector for this year. I think PSU Bank, if I may say so, I think has been, could do substantially well because of the one fact that they are trading at a reasonable valuation. And if you look at certain stocks like PNB, you had a run rate, slippages run rate of about 5,000 crore plus every quarter for the past 14-15 quarters. Now that has come down to about 3,000, less than 3,000 crores. I think that is one of the biggest positive signs which we are seeing in stocks. And if your sector leader SBI also delivers something of this kind, I think probably we could see some bit of a re-rating of the entire PSU bank. So compared to private sector banks, I think PSU banks would clearly stand out.